Before we get started, I just want to make a reminder to everybody that the information discussed today is not to be interpreted or construed as investment advice. Everyone's financial situation, goals, and objectives are different. Please consult investment advice. Welcome back to the Loonie Hour, episode 15. We're going to have a barn burner here today. As always, joined with the three amigos. We got the Tom Brady of macro gearing up for another Super Bowl win. Richard Diaz with Acorn Macro Consulting. And of course, we've got everyone's favorite boomer, Keith Dicker with IceCap Asset Management, rolling with the punches here. Welcome back to the show, gentlemen. As always, this is my one request of all our faithful listeners here. As we grow this community, all we ask is that you share this episode with at least one friend. That's all we ask in return. But let's dive into that, because I think we've got a extremely busy week. There's a good lots to touch on. But I kind of want to start it off on the housing front. So we had the data coming out from Korea, the Canadian Real Estate Association. So coming up with the December numbers, we had national home prices up 26% on a year-over-year basis in December. Of course, that's the all-time record high price growth that we've ever seen. And on a national basis right now, all-time record low inventory. So we finished the year with record home sales, record low inventory to start the year, and of course, home prices up 26%. And that home price inflation is really widespread. It is across all the major cities. Toronto up 31%. Victoria 24%, Montreal 23%, Vancouver 17%, Ottawa 16%, Winnipeg 12%, Calgary 10%. So most sort of major cities in Canada here are experiencing 10+% inflation. So I got some stories, but Rich, I don't know if you have any initial gut reaction to that, but
I'm sure it's totally fine and indicative of a very healthy economy. No, it's obviously that's sarcasm. I think it's dangerous. Who knows when it'll end? You're going to tell us when it ends, but I think the shelter component, which we're going to touch on a little bit later, is crucial to that housing price story. I don't want to gazump us, but no, Keith, what do you have your views on housing? Other than you must be feeling really rich now.
Yeah. I must add, damn Halifax, you guys pissed me off. They're like the one, sort of, I don't even want to call you guys a major city, but they are the one sort of subsection on Korea's website. Like the Halifax Real Estate Board just doesn't release a benchmark price. So I wasn't able to give out the Halifax reading. But Keith, I don't know if you have any comments on what you're seeing in the Halifax housing market. We know you're sitting on a large mansion there. So.
Well, first of all, I think before you asked Rich the comment, you said you have stories on the real estate market, which really caught my attention because I love stories. So I do want to hear one or two of these stories. I can't add any. I mean, Halifax, like any other market right now, the inventory is extremely tight. The moment something comes on the market, there are multiple people bidding on it. And if you're not familiar with Halifax, a portion of the city is a peninsula. So there's no more places to build. All you can do is, create condo buildings. There's lots of that is happening. So, it is one of those markets where everything is being driven higher and higher by lower rates, especially. But Steve, why don't you share with us one of these stories that you're
Yeah, I mean, just kind of what I'm seeing, boots on the ground over the last 4 to 6 weeks, just starting off the year. It's honestly, it's been mind numbing. I go back and I compare this to the bull market we had in housing in 2016, which was kind of influenced predominantly by China's capital outflows, making headlines and pushing up global home prices. What I'm seeing right now is that a pace that far exceeds 2016, the amount of euphoria, the price growth. So for example, I had a client, she was texting me yesterday and she goes, "Oh, can you look into the sale in my townhouse complex? I heard that, they hit this price." So the backstory is in 2015, she lives in an area called in Surrey. She lives in a cookie cutter townhouse complex. They're all the same. Surrey is very much a blue collar working class. It's not a high income area. So she bought her townhouse with me in 2015. She paid $375, 3-bedroom townhouse, cookie cutter. When she bought it, it was 2 years old. Fast forward today, what's that complex now? 7-8 years old. So identical units as hers were selling for $800,000 in October, that's huge, right? $800,000 in October. She's like, she's like, wow, this is crazy. And her neighbor just sold this week for $1,050,000. The same units were going for $800,000 in October. So basically, if you run the math on that, it's a 25% price increase in 3.5 months. So that's kind of what's happening like locally here in the sort of Vancouver housing market. And which kind of leads me to, I think you have every excuse right now in the books that we should be looking at raising interest rates.
Let's talk about inflation first.
Yeah, Rich. I mean, take it away. I'll let you Tom Brady us here.
Oh God, it does not feel comfortable. My girlfriend is just as hot. Anyway, so so inflation came out. I'm going to just go over a couple of these numbers here. I know it's a bit boring, but the numbers provide some context. So the headline number was 4.8%. Core number was 3.5. Now, before we get into this, I want to know, these are the headline numbers. I think a lot of people, including yours truly, my mother, but she would definitely say, what, only 5%? So these are just the headline figures. So I don't want people to come and tell me like, oh, this should be, it's higher. Yes, we all know it's higher, but what are we going to do? It's hard to calculate inflation. And we have to start from some kind of, we need some sort of fundamental starting point. And then from there, we can argue about it. So, but anyway, so just kicking off here. So inflation was 4.8% as expected. So it's been a while actually since the aggregate economist expectations finally nailed it on the head. It happened the last release in the US as well. So after being sort of playing catch up for months and months, we've seen it finally, economists finally catch up to what's going on. Crucially here, goods, which is, you can imagine, are obviously much more susceptible to supply chain issues, are up there near 6.8%. And services, which I'll get into a little bit later, is now starting to really ratchet up. And so all these numbers are either 10 or 20 or 15, in some cases 30-year highs. And for headline inflation, it's 50-year highs. So there's some obviously components. I'm not going to go into them, but you can probably figure them out yourselves, like clothing, recreation, tobacco. I'm not sure who still smokes tobacco, but and there's food and whatever. And one of the big ones, obviously, that's very important is food. And that was like 5%. Again, that's the official number. I think it's much, much higher, but just take a look at your meat prices. But anyways, and then for me, the most important component of the whole thing is the shelter component. Now, the shelter includes things like the cost of operating your home, as well as like rent components, et cetera, et cetera. And obviously this is tied somewhat to the prices of housing. And this is now up to 5.4%. Now, why is that so important? Number one, it took a huge leg up in the last month. And the second thing is that it's almost 40% of your basket. So this idea that, we're going to say the T word, transitory, the idea that you have all these other items kind of roll off as the supply chain stuff unblocks, and that will happen. But one of the key contributors of inflation to core and headline is the shelter component. And it's not clear at all that that's going to sort of slow down. And so that's why I think it's going to put a floor under inflation going forward. So yeah, are we finally going to probably pop off those super highs? Yeah, sure. But I think for me going forward, and for my clients, I think that's the key number that I'm looking at. It's true here. It's true in the US. It's true in the UK. It's not true in Euro area because they calculate inflation a bit differently. But and then the final thing I think is really interesting is number one is to remind everybody that the BOC calculates their own version of core, which is a measure meant to eliminate transitory specific fluctuations in CPI. That's a direct quote. And all of three, which are based on a factor model, I have no idea what that means, based on a median weighted mean, a trimmed mean. So basically trying to account for the big dislocations. All of those are now at 10, 20, and 30-year highs. And so it's amazing how they just effectively ignored their own analysis with respect to the transitory debate. And it's just, listen, we're all feeling it. That's the really sad part. I think it's going to affect working class people more than people who are like Keith sitting in his mansion, eating caviar and counting his gold coins. But we're all in for it. The core producer price, just to end it on this point, which is the core producer prices index, which is, X out energy and X out commodity prices that are directly tied to some supply chain stuff, tends to lead and predict core inflation. And, this relationship doesn't always work. If you follow me on Twitter, you've definitely seen me post this chart before, and I'll share with you guys again. But I mean, let's just say it's even half wrong. We're still going to hit probably 5%, let's say, on the core inflation number. And that's going to hurt a lot of people. So I don't know, Keith, if you want to add anything or maybe point out stuff that I missed.
Yeah, I don't think you missed anything. So two things. One will lead into a good conversation next. So first of all, I feel obviously the central banks are behind the ball. So we'll talk about what actions they may or may not be taking coming up. But also, I just want to introduce the concept as well, is that I think it's not a non-zero probability. I think the probability is a lot higher than people are expecting, that you're going to start to see muted inflation numbers as the year goes on, especially in the second half. And again, these numbers are always lagging. They're lagging. They're not forward looking. But anyway, that's something to think about. So I think next thing coming up, it will be central banks. We have the Bank of Canada coming up next week. Same with the Fed as well. So Steve, what are your friends at the Bank of Canada thinking? What are they going to do?
Well, yeah, no, I just wanted to touch on that just for some of our sort of, because we like to engage with a lot of our Loonie Hour listeners, and I know some are trying to sort of keep up with our macro conversation. So, just want to clarify something, or simplify something. So, as Rich mentioned, you've got inflation at 4.8% on a year-over-year basis. Wage growth, I believe, was 2.7%, right? So, if you really think about this, I mean, obviously, for the most part, it's a squeeze on Canadians unless that wage growth continues to push higher, which that's certainly Rich's research is showing. But, if you think about this even further, like, who does this impact the most, right? I mean, okay, so if you have inflation up 4.8 and wages up 2.7, the only way to sort of buffer that has been through, like, okay, if you own a home, as we've just seen, up 26% nationally, that's been sort of at least a buffer. Now, the people that are ultimately suffering the most is, again, it's the lower to middle class that don't really have any assets. They might be renting a home, for example, trying to save up for a down payment, and that down payment has basically been, eviscerated over the last 12 months or so. So just wanted to clarify that because it does bring us now into our conversation here about the Bank of Canada, because I think the political pressure is rising. I think everybody can see what's happening. Food prices. There's a really good historical case that, typically speaking, it's when food inflation actually starts to push higher, that's when you actually get like that social unrest. When people are, struggling to put food on the table, that's when they kind of have it. So I think that there's political pressure rising with the cost of living, housing prices, food inflation, that we're now seeing aggressive calls for the Bank of Canada to raise interest rates. I think when we talked about last week, I think we had like the market was pricing in 6 or 7 hikes. We've had like a chorus now of big Canadian banks revising their forecast, which I kind of want to get, Keith, your opinion on, of course, and Rich. But like the latest one I got sent to me last night was from Scotiabank, which I kind of made fun of a couple months ago because they were talking about 8 rate hikes by the end of 2023. Now they're saying 7 rate hikes by the end of 2022. So they're suggesting that the overnight rate will go from 0.25 as it is right now to it'll finish the year at 2%. Now, again, if anyone's sort of keeping score at home, you'll remember the last rate hike cycle, the Bank of Canada got stomped out at 1.75%. So we're going to get a decision here. Keith, what is it? January 26th, the Bank of Canada is coming out. And Rich, I don't know if you can tell us or maybe Keith, what the current market is pricing on, like the expectation. I think it's 70% odds they move in January.
Yeah, I mean, well, first of all, every good Canadian knows whose birthday is on January 26th.
Terry Fox?
No, I don't know when.
No, the boomer had his birthday a couple of weeks ago, by the way.
Yeah,
so happy belated.
Hey, thanks. Wayne Gretzky, guys. Wayne Gretzky, January 26th.
Oh,
so if
whenever anyone asks me about Canadian trivia, I always just answer Terry Fox.
Well, you guys don't realize, but a long time ago, when I was a kid, there was a hockey player named Wayne Gretzky, and it was cool. It was cool.
Tell us more, Papa Keith. Tell us more.
Well, back then there was no internet or TV.
Here comes the story.
Here's the story. And I remember he was on pace to try to score 50 goals in 50 games was the thing. And so I was a young kid, and I'd go to bed at night. And I'd wake up in the morning, and my dad, he would have listened to the radio already to hear news. He'd come in and he said, "Keith," I said, "What? He did it." I said, "He did what?" He said, "He got 5 goals against the Buffalo Sabres last night." I said, 5 goals? That's 50 in 39 games. He said, "Yeah, that was cool. I'll never forget that." So that was cool. Anyway, Wayne has a birthday coming up in 6 days. On the same day as the Bank of Canada. So they released theirs at, I think it's 10 a.m. Eastern, I think it is. And the Fed is out in the afternoon as well. So Steve, to answer your question, so right now there's about a 75% chance of a rate hike next week. So to remind everyone, central banks have 8 meetings a year. So for Scotiabank to be correct with their forecast, it means the Bank of Canada will raise rates by 25 basis points or 1/4% every meeting except for one throughout the year. I mean, that's the way the numbers work out with it. So I was chatting with someone yesterday, the day before, I think. They said, what are the odds of Bank of Canada raising rates next week? And I didn't see this number, but I said that it's probably 75% chance that they raise. And really that's what the market is pricing in right now. Even without seeing what the market is pricing in, and my thoughts on a 75% chance of them doing it is, as you say, like the political and social pressure right now on the Bank of Canada has to be enormous. And some of these guys have friends and family, so I imagine somebody is whispering to them, "Hey, you got to do something here." But it's going to create some pretty awkward moments coming up, because let's just say you bought your house last week, and mortgage rates are already going up, and sooner or later prices will start to get adjusted, and 6 months, 12 months down the road, that 1.2, what's this you said earlier, Steve, for the condo or townhouse in Surrey?
Oh, it was a million 50. It went from 800 to million.
Okay, million and 50. So let's just say that's priced at 975, a year from now, or 950, and the price of food is going up. It's going to be tough here. But the bottom line right now in our world is everyone is on central bank watch, and one of the biggest central bank watchers in the world is China. So we'll go into that as well, what came out of those guys. But anyway, I'm expecting them to hike by 25 basis points next week. What about you, Rich? What were you expecting from the Bank of Canada?
I mean, we always talk about what should and what is. I mean, I obviously agree with you. I think they should. I mean, they should. We've talked about this before. They should have raised ages ago. But I'm going to take the other side on that. And I think that they've demonstrated that they have no testicular fortitude. They are unwilling to make the tough decision. And until they prove me wrong, I'm happy to be late to this party. I'm happy to be. I'm in 6 days. If they raise rates, I'll raise my hand and say I was wrong and I'm sorry. But we have to remember sort of where we came from. And if you just forgive this mini digression, like first we were told there is no inflation. This was probably, a year and a half ago. Then we were told that there's some inflation. Then we were told that the inflation that does exist is transitory. And yes, some of it is transitory, fine. But let's be honest, it's government profligacy. It's massive, massive stimulus that has overwhelmingly contributed to that. And then after we were told that it's almost certainly transitory, they've sort of walked off that ledge because they had to. The Federal Reserve did it for them. And now we're being told again that it's a global phenomenon. I mean, I'm mixing the Bank of Canada's position with the government's position because they've done it for us. And so this idea that they're going to turn the boat, a very slow moving, frankly, rudderless boat, away from the fact that it's transitory and away from the fact that it's global, all to the fact that to raising rates when, not long ago did they tell us they're only going to start raising rates in the second quarter of 2022. I find, although the 75% is, 3-1 against, I think, I'm going to stick with my position and say that they won't do it this time around.
Yeah, I'll jump in there. I think that, again, I think they should move. And people go, I actually hope they move because I can tell you, like, even from like a housing front, from like me running my business, like it's too hard to actually do deals right now because the market is just too competitive. Like you take a client around to a house and you get outbid on every house. So like I would actually welcome some rate hikes to cool things off. Rich, I'll take your side and go no rate hike in January, just so the Bank of Canada can piss everybody off. But yeah, I think that
I need to comment here on one thing before you guys look really dumb next week. I think usually Rich doesn't laugh at my jokes and Steve does, but
I look dumb every week, Keith. I look dumb every week. That's what's fun about being in the markets. Every day you're proven wrong somewhere or another.
I think you're the smartest looking guy out of three of us here. So one thing though with central banks and everything, the market will always move in anticipation of what's going to happen. So right now the Bank of Canada, they're behind the curve. So the yield curve, so to speak, it already is shifting. It is rising at certain, especially the 5-year. Steve, I think I shared with you and Rich this morning the Canadian 5-year yield, and that will drive mortgage rates, of course, coming up. But one of the rate metrics in Canada, maybe a lot of people are not quite aware of, is called the Canadian Bankers Acceptance Note. And it's a real good, it's not a perfect proxy, but it's a real good proxy for what the 3-month Bank of Canada rate is. And, I got a good story on the BAX, but that's another day. So we call it the BAX, by the way, BAX, that's the name for it. Actually, yeah, here's the story on the BAX. So a couple of years ago, I was attending it was like a meeting. One of the Bank of Canada governors was there. And at the time, the Bank of Canada, they were the last ones left who have yet to turn dovish in terms of saying, yeah, we're going to cut rates. So every other central bank in the world, they've already said, we're cutting rates. And these guys are saying, no, we're not. We think we're all doing this. So after listening to them present and talk and answer questions, I immediately ran out and said, boy, these guys they're so far behind the ball. They just don't understand what's happening, and they're going to have to cut. And when they do, watch out. So of course, the best way to play in the market is always a way to make money, whether up or down. So the BAX contract, or the Canadian Bankers Acceptance Note, that's the way to play that trade. And we did that, and it worked out quite well. So back to that contract. So right now, the Bank of Canada is at 0.25%, the overnight rate. Right now, as of this morning, the interest rate on this contract is showing 1%. Okay, so the market is already saying, hey, these guys are going to start raising rates. So if you guys think, hey, they're not going to raise rates next week, you guys have to go out and you have to sell this contract. By the way, this is not investment advice. You need to speak with your financial advisor, all that stuff.
That's why I'm talking to you right now.
Yeah, there are certain ways to play this, but right now the markets are definitely saying, hey, the Canadians, they're going to raise rates. So what happens next week if they don't raise rates? All of a sudden you get mayhem and chaos and confusion taking place. And we haven't even talked about the Fed yet. You guys heard the rumor about the Fed this week?
No, tell us.
Well, it's a financial rumor, not the other kind of rumors that tend to come out sometimes.
Are you talking about Ben Bernanke's daughter again?
No, I have no idea what you're talking about.
What's the rumor, Keith?
So there is some talk going around that the Fed is going to hike by 50 basis points, by half a point.
Ooh,
so
that's juicy.
Yeah, like that would be a real shocker to the system if that happened. But yet it does demonstrate though. So here in Canada, Scotiabank, they're trying to, hey, like we think the Canadians will be very aggressive with raising rates. Now down in the US, other houses are, they're doing the same thing from the US perspective. So if we all of a sudden get the Canadians, again, I think they're going to raise rates, which won't be that big of a surprise. A little big, but not enormous. If the Fed raised rates by 0.5% next week, wow, that's going to be a day in the markets, and that's really going to get things moving along. And so just to add some color to this, because I know I've been talking a bit, but this is important stuff, everyone. This is central bank talk. So we've been talking for a while that once the Americans start to raise rates, it's our view that's going to create some stress around the world, specifically in the emerging market world. And this week at the World Economic Forum in Davos online this year again, I think. So Chinese President Xi Jinping, he took the floor. I don't know what number he was speaking, but he was a very prominent speaker, of course. And, he begged the U.S. Federal Reserve not to raise rates. And specifically what he said was, if major economies slam on the brakes and do a U-turn in monetary policies, there's going to be serious negative spillovers. Present challenges to global economic and financial stability in emerging market countries would bear the brunt of it. So again, it's just echoing what, again, this is not something that, it's a secret. We're the only ones that know it. But to hear world leaders actually verbalize it, and it's out there now for everyone to start talking about. And again, to put some more background behind this, everyone else is, raising rates right now. The Chinese cut interest rates this week. So if they cut rates and all of a sudden everyone else is raising rates, again, that's a 2-4, right? That's what's coming up here.
Rich, do you want to rebuttal that?
I think Keith's. I just want to add maybe a little bit of flavor and a little bit of color. So a couple things. So Keith's right on the money in the sense that a huge rate increase would not only shake the market, but it would also screw with interest rate expectations, right? So that would, and so that it would reverberate sort of down the yield curve, so to speak. With respect to China, I think this is the rate cut that we just saw is only sort of the second or third or even fourth liquidity or monetary policy sort of event that we've seen. So obviously, a lot of people are familiar with the Evergrande fiasco. I mean, there's all kinds of opaque financial instruments and companies in China. Evergrande, which is a real estate developer, was just another one in the long list of shenanigans that go on in that beautiful country, really. And in order to sort of react to that, they provided a lot of liquidity. I can't remember how many billions of yuan it was, and that was a couple of months ago. And then after that, they lowered what's called a reserve requirement ratio. Oh shit, I screwed that up. Anyways, the RRR thing, and it's for different banks of different category and size. So and then they added some more liquidity post that, and now this is either the fourth or the fifth. I can't remember however many it is. Kind of move that they've done to basically provide liquidity to the system, increase lending. And just to show you sort of the results of this, And so this is just the first rate cut, of my view, of many. And there will be more liquidity, more monetary policy to ease. You say, well, Rich, why are they doing this now? China had one of the most, throughout this whole COVID, BS, China had some of the highest real interest rates in the world. So what's a real interest rate? It's your interest rate adjusted for some kind of inflation number. And they didn't spend. So Canada, basically, for example, Canadian Bank of Canada and ECB and a bunch of other Western banks, they expanded their balance sheet incredibly. By those same measures, the PBOC, so People's Bank of China, actually reduced the size of their balance sheet. So China's had an extremely, extremely restrictive monetary policy relative to the rest of the world. And they've done so throughout this whole time. So only now are they starting to ease up on monetary policy. And you're seeing like M2 money supply start to kick up. Things like the credit impulse ratio are starting to kick up. I mean, it's technical shit, but that's not the point. The point is they're easing and everyone else is sort of tightening. That's the key things that Keith outlined really well. And I would say, in a way, but where I disagree maybe with Keith is I actually think it's probably good for China that that's actually happening. Because if you look at things like the real effective exchange rate, so some kind of trade weighted index of the yuan, we're actually like basically all-time highs. And China's an export economy. And even to this day, although they're desperately trying to reorient away from that, they're the world's largest exporter. That's how they generate a lot of their growth. And to have such a very strong currency is actually probably not the best thing for them. So the idea that, the world's tightening and they're loosening, specifically the US is tightening and they're loosening, would actually probably help their currency situation, e.g. the currency would become weaker and make their exports more attractive. The other thing that I'd say is I would not at all listen to anything President Xi Jinping says about anything. He is the leader of a totalitarian regime. And I think we should be very, very wary of taking what he says at face value. Sorry, forgive that little editorial.
You're now never allowed to enter China again after that spiel.
I've been there. It was beautiful. I don't have to go back.
So who's left to ban Rich then? So the Chinese, the Canadians, the Brits.
Got kicked out of Argentina or Portugal. So I want to kind of take that all because I think that, some of the listeners here, are going to be like, okay, well, like what does this mean for Canada? Or like, what does this mean for Canadians, like on our day-to-day lives? And so, because I think we've talked about this on the show, and I'm curious to hear what your updated views are. I think most of us have been in the view that the BOC, for example, with all we just talked about, we were in the view that, probably 2 to 3 rate hikes before they kind of get stomped out. Has your guys' view changed? I mean, all I can say is my view hasn't really changed. Again, I think it could it be 4 rate hikes? Sure. That's my current view. I just think like there's way too much leverage and debt in the system. But again, I'm kind of curious to hear your guys' framework. If that's changed, if you guys have gotten, super hawkish with along with the rest of the big bank economists there.
I'll go first. I had to make one more comment on China, but to answer this question first, it hasn't changed. Everyone's going to start raising rates and they'll raise them until they're not able to anymore. And what will happen to stop them from raising rates will be a financial accident, whether, equity is coming off 20, 25, 30%, or, bank funding stress overseas or something like that. So how many will they get? I think before we ballparked 3 to 4, maybe 5. We'll see where we go with it. They are going to start raising rates. Like they're absolutely going to start doing that. But they will not get to that. Is it 9 hikes? No, 8 hikes, right? 8 hikes.
I mean, Scotia's now calling, like, and a bunch of them, like Scotia is the most hawkish, but Scotia's now calling for 7 by the end of this year. So, Rich.
So the longer they continue to raise rates, because what they'll raise rates and they look around and nothing is okay. Everything is staying together here, and then you go another 6 weeks. At the next meeting, it's okay. Let's do another one. You do it again. and then another 6 weeks, and they'll keep doing that until they're told that they have to stop raising rates. That's what's going to happen. If they had a choice, like, they would bring it all the way up to 2 to 3%. That's what they would want. They will not get that far. Like that ain't going to happen.
Rich?
Yeah, so I agree with Keith, and I just want to clarify my position here. It's not that I don't think they're going to raise rates. I guess I'm qualifying my position, so forgive me for backpedaling a tiny bit. It's not that I don't think that it's impossible that they raise rates in Jan. Not to belabor this point, I just think that they've exposed themselves as like fickle, as fickle and feckless. And I don't think, and so until they prove me otherwise, I'm going to just, they've shown us who they are and we should believe them. So that's on that thing. As far as like 2 or 3 or 4, yeah, I mean, I'm exactly the same. I agree with Keith. We should try to gin up some controversy here. So maybe we can change the subject. But I think the U.S. is gonna raise rates, and eventually they'll squawk, as they always do when the markets tank. So
by the way, so back to China. What's going to happen next in China? My view on China is different than Rich. I think those guys are in a lot of trouble. That they're trying to maintain the peg that they use, that try to create confidence in the domestic economy, because the number one risk that the Chinese economy has is that domestic money leaves, and it's already leaving. It's leaving all day long. That's why housing is going up across Canada and the US and elsewhere. I know for a fact money is just flowing out of China through Hong Kong, and it's going out to the rest of the world. And the Hong Kong banking system is stretched to the max as well. But here's something that everyone can write down in the notebook, and you're going to see this data point come out at some time over the next number of weeks or something like that. And it's going to be interpreted incorrectly. So what's going to happen is you're going to see the Chinese are selling their treasury bills or their US treasury bonds. And it's going to be interpreted as this just shows that the Chinese have no confidence in the Americans to run the economy. They think, this is going to happen, that's going to happen, and this is going to happen. They're running for the hills. That proves it. All the commentators on social media that said this, they're going to be jumping up and down and bowing and all that stuff. It is 100% incorrect. So what happens with China and their treasury holdings, so the reserves that they're holding, basically, it's a function of trade. So as Rich pointed out, they're the biggest exporter in the world. Their biggest trading partner, it is the Americans. And the moment that trade begins to slow, which it should now with rates tightening, QE declining, fiscal stimulus slowing, and all that stuff, on a net basis, world or global trade, it should slow. That means there's less US dollars coming into the Chinese system, which means there's less US dollars for them to recycle into the treasury market. So it's just something that, I see it all the time. It's going to happen again, and it's going to be interpreted differently. If China does indeed, if they are the emerging market country that does experience stress, it's actually quite good for the Canadian housing market, especially out west and Toronto, I assume, because again, you're going to see a lot of Chinese money again getting out of that country, and money has to go somewhere. Like, it just doesn't disappear like in midair, and it's probably going to land up in Steve's pocket, I guess. It's with what he does on the weekends, right?
Yeah, I mean, I wouldn't mind chiming in on that. I mean, just because I get this a lot, like people in Vancouver, everyone's always looking for like the scapegoat. And I will say about this cycle in particular, I really have not seen much Chinese money, very little on a relative basis, especially compared back to 2015-16. And again, I don't know. I suspect it's probably because a lot of the Chinese are actually like mandated and locked into their homes back home. That's what I was going to say.
They can't get on a plane with a briefcase full of cash. Seriously.
Like they're literally stuck there. So like, if you look at, like, it's just that's why, like in Vancouver, particularly, like the high end luxury housing market, like it hasn't moved. It's kind of slow. And like, so what you're seeing is it's only these little entry level price points that are really ramping up, where all sort of like the locals are sort of competing against each other. So again, maybe that will change, as Keith mentioned. But as it stands right now, all I can say is very confidently that the Chinese money in the Vancouver housing market is a tiny fraction of what it has been over the last number of years. Rich,
Is that it?
Oh yeah,
Nothing
no, I
else-
want to push
nothing
back
left
on the
to talk
China
about.
thing. No, I want to.
No,
I'm trying not to
yeah.
interrupt you guys.
It's time for my
yeah.
nap soon, guys. Come on, don't keep me up.
I just want to push back on the China thing. So, I mean, I'm no fan of China, but I also think we underestimate the political will with respect to not letting things go badly. And I think it's really important to remember that they have 3.2 trillion US dollars in foreign exchange reserves. And unlike in Canada, where we pretend that the central bank is independent, and it's demonstrably not, in China, there is no pretense, and they can do whatever it is that they want with that cash. And so, yes, although I love that Keith mentioned that there's loads of money leaking. We'll share this chart. It's one of my all-time favorite charts, the net errors and omissions chart. I've talked about it on this pod before. So we'll definitely share that. But what's important to remember is they still have a current account balance that's larger than those omissions and errors. They still do get flows. And I think it's to ignore that that 3.2 trillion dollars, I think is a bit unfair. But I mean, more or less, I think Keith, we're probably closer to the same view than we are apart.
You say they have 3.2 trillion US dollars
In foreign exchange reserves. Yes, sir, they do.
Trillion.
If I'm wrong, I will eat a Twinkie on our next YouTube. Which I can't think of anything worse to eat than a Twinkie. So I will. Yeah, no. If I'm wrong about that, Keith, I'll buy you a beer. But 3.2.
Maybe a donaire. Maybe that would.
It's even worse. Okay, I will eat a donaire.
Do you not question the Tom Brady of macro?
No, I will eat a donaire if I'm anywhere close to wrong. Ugh, I cannot. Ugh.
Have you had a donaire before?
Yes, they're disgusting.
So, I mean, yeah, kind of taking the whole sort of framework, putting all the pieces together. So we've got as we talked about throughout the show, so you've got, inflation putting political and social pressure on central bankers. You've got these emerging markets and China, obviously, that, doesn't necessarily want higher rates, but we're probably going to get them regardless. We're seeing, obviously the strength in the housing market. So how does this all filters through? I think I just want to touch on mortgage rates, because people are going to ask now, okay, so we know the rate hikes are coming. They're already kind of, being priced in. It's just a matter of how many we get until something breaks. And so the question, I'm sure, for a lot of people is, okay, well, when does housing break? When is the opportunity? And, when do I sell my house? Whatever. The one thing that I can say is, and I'm sure Keith will touch on this, but, watching the Canada 5-year bond yield. So that has been pushing higher. That's now reflected in, your 5-year mortgage rate, your fixed term. And so, like a 5-year mortgage fixed rate at any of the big banks today, you're probably you're about 2.8% today. So keep in mind that got down during the lows of the pandemic. You can get a 5-year fixed at about 1.5. So now we're up to 2.8. I've always said that magic number is getting that mortgage rate north of 3%. That's when you start to see pressure on the housing market, but it's, it has to be there for a sustained period of time. The only thing right now, which is, again, sort of keeping the fire going on the housing market, is that your variable rate, which is over 60% of new mortgage originations are going variable for this reason recently, is that your variable rate today is still like 1.4%, because the variable rate is attached to the prime rate, which is, again, influenced by the Bank of Canada's overnight rate. So if that's confusing, just to sort of keep it simple, your variable rate is directly influenced by whatever the Bank of Canada does with their interest rate. So if we get even close to what Scotia says, let's say, let's just say conservatively, you get, let's just say four rate hikes from the Bank of Canada, that pushes your variable rate up 100 basis points. So now you're from 1.4 to about 2.4. So that's when you'll start to see that filter through into the housing market. And you have to keep in mind that most people are on like rate holds. So when you go to the bank, your mortgage broker will secure your rate at the lowest rate for usually 3 to 4 months. And then that expires and you have to renew at the higher rate. So you have a lot of buyers, in my opinion, when they start to see, and this is kind of counterintuitive, is when they start to see that the Bank of Canada actually begins hiking rates. All they read is all most people do is they go on CBC News and they go, oh, interest rates are going up. I better purchase now, because if I don't, my interest rate lock will go up and I'll be paying more on my mortgage. So I better go today. And it is counterintuitive, because most people that are watching the show are thinking, well, hey, if you have higher rates, wouldn't that effectively impact, demand in the housing market, slow prices? That's not how most people think in Canada, because they don't really understand the whole dynamics. They just see rates are going up, I must move now. So I think you probably get one more big push in the housing market before you start to see those rate hikes really filter through.
I have a question for you. Again, like, this is not my market. So are you saying then, because, we all know, as an example, let's just say we're 1% assured that the Bank of Canada will raise rates next week. Are you saying the prime rate has yet to move? They won't adjust prime until after it's announced? I'm just trying to understand. No, do people have the opportunity to run the market, like to go in today and get pre-approved and then sort of miss or sidestep this potential rate hike next week? Is that what happens?
Your prime rate will move up with the BOC.
Up before, so they haven't adjusted prime already.
No, they have not. That's my understanding, and the discount rate is pretty much the same, right? So it's like the banks will say it's prime, which I think is 2.45 right now.
Exactly, I just checked it.
Yeah, whatever your discount rate is. So I think, like, right now, like I said, most banks are saying prime minus 1%, which means your variable rate is.
No one pays prime anymore. It's always prime minus.
Prime minus, yeah. But the banks can say on a risk adjusted basis, oh, this housing market looks really shaky. Let's remove our discount rate. And so they could hypothetically just go, hey, now we're only offering prime minus 0.5. And that could change as well. So long story short is your variable rate is going to go up, and that's going to start to follow what's been happening in the 5-year fixed rates. So again, when you have these massive moves, like we talked about at the beginning of the show, where a townhouse goes up 25% in 3 months, like if you have a 50 basis point move in your mortgage rate, like it's going to start to suck some of the wind out of the housing market. So
there's less money available to go after it.
Yeah. Because everybody
add something else here. So, again, we talk about the bond market sometimes. So some people, maybe they're not watching it as closely as we do, but picture say 4 different bonds: a bond that matures next week, another one that matures 5 years from now, another one 10 years from now, one 30 years from now. And there's as you get longer with the maturity date, there's a higher interest rate attached to that. So when you link all those together, that's what we call a yield curve. The Canadian mortgage market is mostly on the 5-year and shorter period. And you've heard us talk about over the last 2 weeks how the bond market has been crushed at the long end of the curve. So what I suspect will happen, so here's 2 contrarian trades that I see right now. Again, I was chatting with a friend yesterday. He said, do you think the US 10-year will reach 2%? And I said, I think there's probably a 25% chance it does. So right now, I think there's a probability that like 10-year rates and longer, they may be peaking this week. Maybe the price of those bonds have actually troughed and they're starting to recover. All the volatility's been sapped out of it. So that trade seems to be over there. So really in the Canadian bond market, the 5-year may not come down as much, whereas US mortgage rates at the 30-year, they can come down quite a bit from here. And then at the opposite end, when all this is happening, I think oil prices may have peaked as well this week. So you get the opportunity. Yeah, we have that. Again, these are trades that we see with different models that we use. and so forth. But again, it's a reminder that when everyone is on one train or one boat or whatever Rich drives around in all the time.
I walk.
He walks. He has big shoes, by the way, guys. Big shoes. Those are when you sort of say, okay, it's moved a bit too much. So, because again, everyone else saying, hey, rates are going up. I think there's a probability that the long end of the curve is sort of paused right now, and it could come back a little bit. So everyone looking to buy a house again, you may not have to panic over the next 2 weeks. You might get another chance, 3 to 5 weeks after that.
So can I just? Oh, go ahead, Steve.
I want you to touch in on oil, obviously, because I know you're
fighting words, aren't they? Look at these guys. Look, the old guy is still awake at like 2 PM, and these young guys are.
Well, there's oil, and there's the maturity thing, which I think. But you go ahead, Steve, please.
No, all I was going to say is in terms of opportunity in the housing market, I don't see that opportunity arising probably until the end of the year. Until those rate hikes have to filter through into like these mortgage pre-approvals and you have record low inventory. So like, it's going to take time to filter through. I think that the Bank of Canada, like, as we talked about throughout the show, they'll continue to keep hiking until something breaks. And so nothing's going to break here in the first 3-4 months. Like if something's going to break, it's probably, a little bit later on towards the end of the year. So that's my opinion on the housing market. If you're looking for that opportunity, so to speak, it's probably towards the end of the year. But Rich, take it away. I know you're chomping at the bit here on the oil.
Well, before I get to the oil thing, I think what's really kind of interesting, and I think one of the reasons I absolutely love my job is because I have access to all this wonderful, wonderful data. And it's not only the mortgage market that's tied to the front end of the curve. Nearly all of the new debt issuance that our dearly beloved finance minister chose to issue was in the on the short end of the curve. So when the Bank of Canada lowered interest rates and obviously did all this MMT to suppress rates, to keep rates low. It's not technically MMT, but anyway. So when the Bank of Canada lowered rates, the government of Canada, in their infinite wisdom, issued shitloads of debt. And instead of issuing debt really far out the curve, which at the time would have been really, really sensible, right? You're saying, well, we're going to goose the economy. We're going to create lots of inflation. Let's fuck over the bondholders really, really far out. But instead, they issued nearly all of the debt, and I will prove this in a chart. They issued all of their nearly all the issuance, probably 60-70% or whatever the issuance was in the front end of the curve, so 5 years and less. And so what does that mean? It means when they have to roll over the debt in one year, 3 years, 5 years, that instead of rolling, they're going to have to roll it over at a much, much, much higher interest rate. That's assuming that the world doesn't go into deflation and ultimately revolution. But let's just assume things are going to, things go okay over the next few years. Interest rates will be higher than they are today. And when the government of Canada has to roll over all of the debt that's been issued over the last 2 years, it's at the front end of the curve. So I'll be happy to share that chart, but that was just a little delicious piece of information that really kind of turns me on. I love doing that kind of stuff. As far as oil is concerned, I just think Rich, as Canadian, yep, go for it.
Whoa. Do you have the Canadian federal debt maturity?
I do, but I can't. Sorry, this is shit radio, but I can't pull it up quickly like this.
Maybe we can share that with everyone.
Definitely.
It'd be really good for people to visualize. Hey, we have this much debt, and because it's really important to see when these debt bubbles are coming up. And,
so I don't have the maturity. I don't have the exact maturity, although we can definitely look that up. What I do have is the issuance by maturity and how that's changed over the last, let's say, 20 years or however long the series goes for. And so what you can see is, and what's amazing about this chart, which I'll show, is the bond issuance is usually quite far out the curve. And obviously, as time goes on, a 10-year bond turns into a 9-year bond, which turns into an 8, et cetera, et cetera, et cetera. But what this finance team did was they issued a crap load of debt at the front end of the curve, which is the 2s and 3s and 5s, which is already now going up, right? So it's just such a fucking embarrassment.
I have a question. I have a question on that.
Go for it.
Can you not just make the argument like, okay, if you're like just like a household, can you not just look at that and be like, well, the public sector, the government sector is completely screwed. That they're going to have to try to roll all this debt, and like, what is not the release valve just the currency, like,
or inflation,
right?
Yeah, well, there's another thing to consider as well. So from a very high end, we call it an aggregate level around the world. Aggregate global savings, it's enormous. It's still enough money to absorb all this debt issuance. Sure. So, I mean, one thing, in defense of, all the Finmans, when all the treasury departments and ministers of finance, when they're issuing debt, they'd say, well, that's what the market is paying for it, in which, we would, Rich would reply and say, well, Bank of Canada is actually buying a lot of it. But the fact still remains that the amount of money in retirement plans, whether it's defined benefit plans or defined contribution plans, RSPs, and a lot of people, listeners here, if your money is going into a target date fund, you should clearly call someone who can tell you some of the risk you might have that you may not be aware of. But the point is, though, that there's a lot of money that automatically flows into the bond market, and they're mopping this up. But there does come a point, that tipping point, because again, what's the surplus going to be this year, Steve?
0. I don't know what the deficit's going to be this year. I don't have the numbers.
Hilarious.
I just want to wake them up. Yeah. But again, though, that's the point, right? No one is running a surplus. And the moment they do, everyone runs into the room with their hands out. Oh, we got a surplus. Let's spend it. There's increasingly more debt all the time. And the point Rich is making, which a lot of people don't sort of see, is that, they're borrowing an extra 60 billion this year, whatever the number is. But coming right behind that, they might have another, I'm going to guess, 300 billion that's maturing as well at the same time. And it could be at the exact moment in time when the Bank of Canada is no longer doing their bond buying program or quantitative easing. And then when the Americans are reducing theirs, and I don't think that the Europeans can do it, but on an aggregate level, if more countries are doing that, we have this thing called bootstrapping in the yield curve market, really, where one bond is priced off another bond, which is priced off another bond. There is the real opportunity here, for rates to get out of control. And I love this stuff. We can talk about it all day.
So can I just add two more things? One is, I just want to say, this is not Monday morning quarterbacking. I know a lot of the times we criticize policymakers for decisions after the fact, blah, blah, blah. It was clear at the time. And if you go back and look at, I'm not even going to mention the guy's name, but he doesn't deserve a plug. But there was loads of people in question, in Prime Minister's question time, who are saying, what are you doing? This is not a good idea. And so to his credit, he's the one who got me sniffing around there. And you can see the data is clear, and I'll be happy to share it. And the other thing on the savings rate, I know this is getting a little bit technical, but what's so delicious about this whole bond issue and stuff and the savings is that we're entering the period where baby boomers like Keith are about to retire, and they're going to stop generating lots of millions and millions and millions of dollars of income and starting drawing on those savings. And so maybe that's a conversation for a different pod. But, when we look down the road at 5-10 years from now, when you have that savings being consumed and drawn down, it's going to be interesting whether or not all this debt can be resold, refinanced, basically. Yeah, thank you. Sorry, I gobbled that, but
absorbed.
But
can we talk about oil?
But no, this is the whole thing that we've been talking about. Like that, you literally just summarized everything that we've been talking about, which is why we keep saying, okay, yeah, it's 2, 3, maybe 4 rate hikes. Okay, great. Even if you get to 7 this year, like Scotia's bank is saying, it's you're basically forced, where given the demographics and the debt that has to be rolled, you're basically forced to go back and hit Control P and start printing again.
But this is if you subscribe to my note, you'll know that I've been on this train for a long, long time, this is why I think inflation is not something they're fighting. Inflation is the policy stance. The only way, you were asking about how does the circle get squared? Is it the currency? I think, Canada's currency is tied to oil. We can skip that. But the issue is, and everyone's doing the same sort of shit. So it's, you're all fighting against one another. But to me, the only way any of this debt gets paid, in inverted commas, is it doesn't. It's inflated away. And so so whether or not there's a rate hike today and tomorrow, and they pull back and they go forward and they pull back, whatever, it's irrelevant. Interest rates are materially below the rate of inflation, however you define it. And so if you sustain that process for a long, long time, the real value of your debt goes down and people get paid. And so that's how the circle is squared. I mean, that's my view. That's coloring all of my asset allocation decisions. I'm happy to share notes I've written about it and stuff, but I don't know if you guys.
Keith, I actually want to just plug you here for a second, because I think Rich just summarized it magnificently. So to kind of wrap this up, Keith, do you have any comments on that? Like, as Rich is kind of saying, right? Like, the debt will be quote unquote paid, but it'll be paid back in this debased currency where, okay, we paid it back in nominal terms, but like, you got it paid back in like something, a loaf of bread's $10 kind of thing, and whatever. Do you have any comments on, like, again, like from the portfolio side? Because like when I hear Rich say that, all I can think about is like, one of my close family members that's like a school teacher that's in like, or like my brother that works for like the government. And it's like, yeah, you've got this like defined pension, but like, what is the value of that? Like, yes, I know it's indexed to inflation, but like, is CPI a really accurate measurement? Like, do you have any comments on that, Keith? Like, I mean, in terms of like these defined pensions and what the actual like value of them is? Because like everybody I know like that has a pension just like assumes it's going to be there, assumes it's going to be worth what they say it's going to be worth, and that they'll be able to, retire at 55 and it will sustain them.
Yeah. So there are two kinds of pension plans in the world. There are defined benefit plans, and those are the ones where you pay in your money every paycheck. And when you turn 55 or 65, you're going to get, say, 70% of your salary or 50% of your salary or something like that. That's when everyone says, oh, you don't ever worry about your pension plan. If you open up every single defined pension plan, and you look at the assets that are in there, because, their investment managers have to invest it. I would have a very good guess that most of these plans have anywhere from, say, 30 to 45% in the bond market. That's where it is. And then the rest is in the stock market, real assets, and, a number of different things. And typically that part of the portfolio, like the risky market, like equities, stuff like that, that's considered to be risky and volatile. And other stuff is considered to be, hey, safe and secure and everything. I would argue it's been flipped on its head, because the moment we get this crisis in the bond market that's going to come up, again, you get permanent losses. So all these defined benefit plans that have 30 to 45% in the bond market, there is the opportunity there for that part of the portfolio to have permanent losses. Because remember, when the stock market drops 25%, it does recover. There's always residual value in the stock market. If you get a loss in the bond market, it could be a permanent 15% write down, or whatever number you want to go with. And then all of a sudden you realize, hey, the pension plan itself doesn't have enough assets to pay out all the payments into the future. Now that's what now we're getting, some really interesting conversations. But the point is, you might, if you're a member of these pension plans, you might hear the term that your plan is fully funded or it's in a deficit. Again, what I strongly encourage you to ask some questions, and like the main one is, what is the expected rate of return, for the plan? And no, you'll be shocked at a lot of these things. But sort of coming back with the whole thing with the bond market in Canada specifically, and you guys may not remember this because it was 20 years ago almost. I don't know what you guys were doing then, but back in the early O's, the Canadian dollar got down to like the low 60s. So I remember people then were saying, oh my God, it's going to 50 cents, it's going to 25 cents. It was dropping like a stone. And at that time, the reason for that happening was because of all the debt problems that we had in Canada. We had this incredible amount of debt. We were running deficits. We had to raise taxes, cut spending, and all that stuff. And a lot of that started to happen. And at the same time, energy markets started to take off as well, commodity markets. So that really helped. Globalization was ramping up. So a lot of tailwinds kicked in to help pull Canada out of that. The challenge today is that we're right back to that same moment in time where we have this big debt problem, where we're spending way too much money. It's going to be pretty tough to hike tax rates from here because we're already taxed pretty high. And this is where we jump in the conversation. You know, the Irish have the same problem. The French have the same problem. The Italians, the Americans, you know, everyone in the world is at this exact same moment in time. And that's where the whole bond market, you know, start to do really funny things, you know, which then creates the opportunity for other markets to go a lot higher. So we are rationally exuberant about what might come up here in the future.
Well, I think
does that make sense to anyone or no? Rich is laughing.
I think you did. I'm laughing because, you know, it's funny. You and I often we disagree about some detail stuff, but as what you just lay out is sort of. I'm laughing because it's obvious to the point where I'm like worried about, you know, maybe we're wrong, but I think you did such a really good job explaining it. Frankly, that's why I'm smiling.
Well, the irony here right now is that policymakers all around the world, not just Canadians, they've created this environment where older people, they've always been told to believe that the bond market is safe. When you get old, hit retirement, buy bonds and GICs, and you'll never have to worry about anything. And however, if you take a really long-term look at, especially the interest rate market, this is the exact worst. I have a story for you. Here we go. 1982. I'm chatting with, not back then. I was
before the internet, kids.
It was before the internet. It was before TV. We had one TV station. However, but I was chatting with a guy that was managing money back then, and he told me, he said, Keith, the broker called him to buy a Ford Motor Company bond that was yielding, I think it was like 16%, something like that. And this guy said, he said, we wouldn't buy it. He said, this broker could not sell that bond. Anyone on the street, nobody wanted to buy a 16% yielding bond. And that was actually the low point of the bond market. Now, here we are today, everyone, including pension funds, they're tripping up over themselves to buy a bond that has, say, a 1% yield. Or get ready for this, everyone. If you're in Europe, these bond managers are buying bonds that have a negative yield. So they're guaranteed to lose money. And I know any consultants listening are going to say, well, they're doing this, for, liability asset matching and stuff like that.
Spread matching, yeah.
Yeah, but however, once you get permanent losses in the bond market, all that consulting stuff goes out the window. You're going to get fired. If you're a consultant, rethink what you're thinking here, guys. Again, it's so easy to see what we're faced with.
Well, I mean, I think just to kind of summarize, right? I mean, I think this, like in Canada, everybody's kind of got their blinders on as asleep at the wheel. I mean, all we have to do is look at the policymakers that are, running the show. I mean, we talked about the Bank of Canada has been saying inflation has been transitory. They've been saying for the last 18 months that inflation in the housing market was transitory, that it was just pandemic induced activity. And then again, not to ramble on, but like this week, right? Like if you look at Canada, what do we have? We've got a supply chain crisis. We've got high inflation, 30-year high. And what does the government decide to do? Oh, let's close the border to unvaccinated truckers. Like that's not how you fix a supply chain or inflation problem. But these are the kind of people that are running the country. So as to Keith's point, same thing, sometimes the higher Bs that, are running your portfolio, you always have to ask questions, do your own due diligence. And, that's really what the show is all about, is just, we wanted to put together a podcast, having a conversation about, macroeconomics and how it impacts, Canadians' day-to-day lives as sort of an alternative news source, because I don't think this conversation is out there. And I think it's an extremely important conversation because everybody works, hard in Canada, and everybody wants to protect that hard-earned capital and create a store of value long-term so you can have a proper retirement. So as always, we'll wrap it up there. We certainly appreciate the ongoing support.
One more prediction before we go. San Francisco 24, Green Bay 13.
Big 49ers fan. You heard it there first. Keith Dicker, you can take that to the bookie. But yeah, appreciate the support. If you can share this episode again with one person, that's all we ask. Text them the link to the Spotify or Apple iTunes podcast. Share it with one person. Let's grow this community. And we'll see you next week.